Something unusual happened to Plug Power today. The stock suddenly surged, trading volume exploded, and hydrogen investors rushed back into one of the market's most controversial clean energy companies. But if you think this rally was simply about hydrogen hype, you are probably missing the real story. Because the real reason Plug Power surged today may have very little to do with optimism, and everything to do with survival. Plug has become something much bigger than a normal hydrogen stock. It has become a stress test for the entire green hydrogen economy. For years, the hydrogen industry operated in what could be called the announcement phase. Governments announced billions. Companies announced gigawatts. Investors funded massive future projections. Every week brought new press releases about electrolyzers, green ammonia, fuel cells, hydrogen trucks, hydrogen aviation, hydrogen shipping, and trillion-dollar decarbonization opportunities. But then the system encountered reality. Interest rates rose, electricity prices became volatile, grid congestion worsened, infrastructure timelines slipped. Projects struggled to reach final investment decision. And suddenly investors realized something critical. Hydrogen technology working in theory is completely different from hydrogen surviving economically under real-world system stress. That is the phase the industry has entered now. And this is why Plug Power's rally matters far more than most people realize. Yes, investors reacted positively to the company's recent quarterly results. Revenue improved year over year, margins showed improvement compared with prior periods, and the company highlighted momentum in electrolyzer deployment and hydrogen infrastructure expansion. But the stock did not surge simply because one quarterly report looked better. It surged because Wall Street may be reassessing a much deeper question. What if Plug Power survives the hydrogen consolidation cycle? That changes the investment framework entirely, because the hydrogen economy is quietly transitioning from a hype-driven market into a survivability-driven market. And survivability changes everything. For the past several years, investors rewarded hydrogen vision. The market rewarded ambitious announcements, future capacity targets, and trillion-dollar narratives. But now investors are becoming more focused on something much harsher. Which companies can survive low utilization, expensive financing, delayed infrastructure, weak margins, and difficult power economics? That is the real hydrogen battlefield now, and Plug Power sits directly at the center of it. The company spent years trying to build something unusually ambitious, an integrated hydrogen ecosystem. Not just electrolyzers, not just fuel cells, but hydrogen production, logistics, storage, fueling infrastructure, and customer integration all at once. Critics argued this strategy was too capital-intensive and too risky. Many of those criticisms were justified because Plug became one of the most cash-burning companies in the entire hydrogen sector. Even today, significant risks remain. The company is still unprofitable, cash burn remains substantial, hydrogen infrastructure remains expensive, financing conditions remain difficult, and the hydrogen economy still faces major questions around utilization, project bankability, and long-term demand growth. But the industry itself may now be revealing something unexpected. Partial hydrogen systems may not survive. That is an extremely important shift. Hydrogen is not like software where one successful application can scale independently. Hydrogen requires synchronized infrastructure. Electricity supply, electrolyzers, compression, storage, transport, fueling systems, industrial demand, and financing structures all have to function together simultaneously. That creates enormous complexity, but it also creates a strange advantage for companies capable of integrating multiple layers of the system. And that may be what investors are beginning to notice with Plug Power. There is another hidden factor driving renewed interest in hydrogen infrastructure: AI. Quietly, AI-driven electricity demand is beginning to reshape energy conversations globally. Data centers are consuming extraordinary amounts of power. Utilities are facing growing load pressures. Grid reliability concerns are increasing. Backup power systems are becoming strategically important again. This changes how some investors are evaluating hydrogen. Hydrogen fuel cells are increasingly being viewed not only as climate technologies, but also as infrastructure resilience technologies. That distinction matters enormously, because infrastructure resilience markets behave differently than purely environmental markets. reliability can justify premium pricing in ways that sustainability narratives alone sometimes cannot. Some investors now believe hydrogen fuel cell systems could become increasingly relevant in data center backup power, industrial resilience systems, and distributed energy infrastructure. This does not mean hydrogen automatically wins. Far from it. The industry still faces severe economic realities. Electrolysis remains energy-intensive. Hydrogen infrastructure remains expensive. Storage and transportation complexity remain major barriers. And hydrogen systems still suffer from multiple energy conversion losses across production, compression, storage, transport, and reconversion. The physics has not changed, but investor perception may be changing, and markets often move before certainty exists. Another important factor behind today's rally is market structure itself. Plug Power has been heavily shorted because many investors believed dilution risks, persistent losses, and financing challenges would eventually overwhelm the company. That skepticism did not come from nowhere. Hydrogen markets have experienced significant disappointment over the past several years. But heavily shorted stocks can move aggressively when sentiment shifts even slightly. As shares rise, short sellers sometimes rush to close positions, creating additional buying pressure that accelerates upward momentum. That dynamic can amplify stock moves far beyond what fundamentals alone would normally justify. Hydrogen stocks are especially vulnerable to these violent sentiment swings because the sector remains highly narrative sensitive. And right now, the hydrogen narrative may be changing. The previous dominant narrative was collapse, projects delayed, capital disappearing, weak economics, and unrealistic expectations. But now a different narrative may be emerging. What if the companies that survive this difficult hydrogen cycle become disproportionately valuable later? That possibility is what Wall Street may be trying to price today. Not certainty, not guaranteed success, not hype. Selective survivability. And for ReneEnergy, this is the deeper lesson hiding underneath today's stock move. The future hydrogen economy may ultimately become much smaller than early hype predicted, but potentially far stronger and more durable. Weak projects may disappear, overbuilt assumptions may collapse, capital allocation may become more disciplined, infrastructure deployment may become more strategic, and the companies that survive this stress cycle could emerge with meaningful competitive advantages. Because the hydrogen economy was never going to be won by the best press release, it will likely be won by whichever companies can survive long enough to build infrastructure systems under real-world economic pressure. That is the real reason Plug Power stock surged today. This video is for informational and educational purposes only and should not be considered financial advice. Always conduct your own research before making investment decisions.